I want you to imagine you are standing in the middle of a vast, ancient cathedral. It is silent. The stone pillars rise up into the darkness above you. For centuries, this structure has stood firm, unshakable, a testament to stability and permanence. But then you feel it. It isn't a noise at first, it is a vibration, a low-frequency hum that you feel in your teeth before you hear it with your ears. You look down at your feet, and you see a tiny crack running through the stone floor. As you watch, the crack widens. It splits the marble. Dust starts to fall from the ceiling. The vibration turns into a rumble, and the rumble turns into a roar. You realize with a sudden jolt of terror that the foundation, the very bedrock upon which this cathedral was built, is liquefying. This cathedral is the global financial system. The foundation is the United States Treasury bond market, and the vibration you are feeling right now is the sound of the world's most important asset class losing its credibility. We are living through a moment in history that will be studied for generations. We are not just watching a bull market in precious metals, we are watching the systemic failure of the debt-based fiat currency model. If you are watching this video, it is because you have seen the price of gold flirting with $5,000. You have seen silver pushing past $100, and you are asking yourself, is this it? Is this the top? Is this a bubble? And I am here to tell you that this is not the top. This is the launch pad. We are witnessing the early stages of a violent repricing event that could send silver to $300, $400, or even $500, and gold to $8,000 or higher. The driver of this move is not speculation. It is not meme stock mania. It is a nuclear panic in the treasury bond market. To understand why silver is going to the moon, you have to understand why the bond market is heading for the abyss. For the last 40 years, U.S. Treasuries were considered risk-free. They were the pristine collateral that backed every bank loan, every pension fund, and every derivative contract in the world. The entire financial architecture was built on the assumption that if you bought a U.S. government bond, you would get paid back, and the money you got back would be worth something. That assumption is dying. Right now, bond yields are spiking. The price of bonds is crashing. The market is demanding a higher and higher interest rate to lend money to a bankrupt government. This is the bond vigilantes waking up. They are looking at the $35 trillion in debt, the $2 trillion annual deficits, and the unpayable entitlement liabilities, and they are saying no more. They are selling the bonds. When they sell, yields rise. And when yields rise, the cost of servicing the U.S. debt becomes mathematically impossible. We are already paying more in interest on the national debt than we spend on the entire defense budget. If yields go higher, the interest payments will consume the entire tax revenue of the country. The government will have to shut down. The military will have to go home. Social security checks will bounce. This is the nuclear scenario. It is a total systemic collapse. But there is a trap door. There is one way out. And the market knows the government will take it. The Federal Reserve will print the money. They will not allow the U.S. government to default. They will not allow the bond market to seize up. They will intervene. They will implement yield curve control. They will print trillions of dollars to buy the bonds that nobody else wants. They will flood the system with liquidity to force interest rates down. And that, my friends, is the rocket fuel for gold and silver. The market is forward-looking. The market sees this coming. The rise in metals is the market pricing in the inevitable dilution of the currency. We are not seeing gold go up. We are seeing the dollar go down. We are seeing the trust in the treasury bond evaporate. When the risk-free asset becomes risky, the only true safe haven left is the asset that has no counterparty risk, the asset that cannot be printed, the asset that has survived every empire collapse in history. This brings us to the concept of time compression. You might have noticed that the markets are moving faster than they used to. In the 1970s, the gold and silver bull market took 10 years to play out. It was a slow grind with periods of explosion. Today, we are seeing moves that used to take months happening in days. We are seeing corrections that used to take weeks happening in hours. This is time compression. It is caused by the speed of information, algorithmic trading, and the sheer desperation of the capital trying to escape the burning building. When confidence breaks, it breaks fast. Trust is earned in drops and lost in buckets. We are in the bucket phase. The world's capital is realizing that the bond market is a trap. There is over $100 trillion of capital parked in global bonds. If even 1% of that capital decides to rotate into precious metals, the price of gold and silver will not just double. It will go vertical. The silver market is tiny. It is a microscopic speck compared to the bond market. Trying to shove trillions of dollars of bond money into the silver market is like trying to push the water from the Hoover Dam through a garden hose. The pressure will blow the price to levels that seem impossible today. Let's talk about the specific dynamics of silver and why the target is $300 to $500. Silver is the high beta version of gold. It is gold on steroids. When gold moves, silver moves further and faster. But recently, silver has been lagging. Gold broke out to all-time highs long before silver did. This created a massive coiled spring. The gold-to-silver ratio is currently sitting around 50 to 1 in this scenario. Historically, when the metals enter a mania phase, that ratio collapses. In 1980, it went to 15 to 1. In 2011, it went to 30 to 1. Geologically, it is 8 to 1. If gold goes to $8,000, which is a conservative estimate if the bond market breaks, and the ratio returns to a historical norm of 20 to 1, that puts silver at $400. If the ratio overshoots to 15 to 1, silver goes over $500. This is just math. It is mean reversion, but it is mean reversion powered by a currency crisis. You have to understand the psychology of the market right now. The smart money, the central banks, the sovereign wealth funds, the billionaires, they have been buying gold for years. They built the floor. Now, the institutional money is starting to panic. The pension funds, the insurance companies, they are realizing their bond portfolios are bleeding. They are looking for a hedge. They are starting to dip their toes into the metals. But the retail public, the average person on the street, is barely involved yet. When your neighbor, your taxi driver, and your cousin start asking you how to buy silver, that is when the mania truly begins. That is when we see the vertical move from $100 to $300. But I must warn you, this path will not be a straight line. It will be violent. We are going to see volatility that will make your stomach churn. There will be days where silver drops $20 in a few hours. The bullion banks will try to smash the price. They will try to trigger your stop losses. They will try to shake you out. This is the shakeout. It is designed to transfer wealth from the weak hands to the strong hands. Imagine silver hits $150. The news is screaming bubble. The banks dump a massive amount of paper contracts on the COMEX. The price crashes to $110. You panic. You think, I missed the top. It's over. You sell. And then, the very next week, the bond market cracks again. The Fed announces a new stimulus program, and silver rips to $200. You are left on the sidelines holding devalued paper. Do not let this happen to you. You must have a core position that you do not trade. You must have conviction. This conviction comes from understanding the fundamental drivers. Let's look at the industrial floor. Unlike gold, silver is an essential industrial metal. It is the best conductor of electricity on Earth. You cannot have a green energy transition without silver. You cannot have solar panels without silver. You cannot have electric vehicles without silver. You cannot have AI data centers without silver. You cannot have Tomahawk missiles without silver. The industrial demand for silver is exploding at the exact same time that investment demand is waking up. And here is the kicker. Industrial demand is inelastic. A solar panel manufacturer cannot stop buying silver just because the price goes up. Silver is a small percentage of their total cost, but it is essential. They will pay $50, $100, $200. They have to. If they don't, they go out of business. This creates a floor under the price. The investors might panic sell, but the industry will scoop up every physical ounce that hits the market. We are in a structural deficit. The world consumes more silver every year than the miners dig out of the ground. We have been filling that gap with above-ground stockpiles. But those stockpiles are draining. The vaults in London and New York are bleeding inventory. When the stockpiles are gone, the price has to rise high enough to incentivize new mining or massive recycling. But it takes 10 years to bring a new mine online. You cannot just flip a switch. This supply crunch is hitting exactly when the monetary demand is exploding. It is the perfect storm. Let's go deeper into the bond panic. Why is it happening now? It is happening because of fiscal dominance. This is an economic term that means the government's debt is so large that it dominates monetary policy. The Federal Reserve is no longer independent. It cannot raise interest rates to fight inflation because high rates would bankrupt the government. It has to keep rates artificially low to keep the government solvent. But keeping rates low when inflation is high is a recipe for hyperinflation. It destroys the currency. The bond market sees this trap. The bond market knows the Fed is cornered. If the Fed fights inflation, the bond market crashes and the economy collapses. If the Fed saves the bond market, they have to print money, which causes inflation. There is no good option. The path of least resistance is always to print. It is always to devalue. It is easier to destroy the currency than to cut spending or default on the debt. This is why the T-bond nuclear panic is inevitable. It is the mathematical end state of the debt supercycle. When the panic hits, you will see things you have never seen before. You will see treasury auctions fail, meaning nobody shows up to buy U.S. debt. You will see the yield curve lose all meaning. You will see the dollar spike and then crash. In that chaos, capital will flee to the only assets that are outside the system. Gold and silver. Gold at $8,000 sounds like a lot. But you have to ask yourself, $8,000 of what? $8,000 in 2026 or 2027 might buy what $4,000 bought in 2020. We are measuring the metal with a shrinking ruler. The price is just the exchange rate between sound money and dying fiat. If the dollar loses half its value, gold doubles in price without doing anything. But gold is doing more than just tracking inflation. It is pricing in the risk of the entire system failing. We are seeing a repricing of sovereign risk. For decades, U.S. debt was considered risk-free. Now, the market is starting to price in default risk. Not an explicit default where the government says, we won't pay, but an implicit default where they pay you back in worthless confetti. Gold is the hedge against that default. Now, I want to talk to you about the halfway trap. This is a psychological danger zone. Let's say silver goes to $150. You have made a lot of money. You feel like a genius. Your friends are telling you to sell. You start to think, maybe I should cash out and buy a nice car. Do not fall for the halfway trap. In a currency collapse, the asset prices go much, much higher than you think possible. In Weimar Germany, people sold their gold too early and ended up starving because the currency continued to collapse for another year. You hold the metal until the fundamental problem is solved. Has the debt been fixed? No. Is the budget balanced? No. Are real interest rates positive? No. Then the bull market is not over. You hold until you can exchange your silver for another real asset that is undervalued. Maybe you swap your silver for a farm or a business or an income-producing property. You do not swap it back for dollars unless you have an immediate use for those dollars. The violent nature of this move cannot be overstated. We are going to see days where the market is halted. We are going to see gap-ups where the price opens 20% higher than it closed. This is because the physical market is taking over. For years, the price of silver was set by the paper market, the futures contracts on the COMEX. Banks would trade paper back and forth to manage the price. But now, the physical buyers are standing for delivery. They want the metal. When there is not enough physical metal to back the paper contracts, the paper market breaks. The short squeeze forces the banks to cover their positions at any price. This is what sends silver to $300. It is a squeeze on the physical float. There is very little available silver in the world relative to the amount of money trying to buy it. I want you to think about the geopolitical angle as well. The world is fragmenting. The Pax Americana is ending. The BRICS nations, Brazil, Russia, India, China, South Africa, and others, are building an alternative financial system. They are accumulating gold. They are trading in local currencies. They are bypassing the dollar. This reduces the demand for U.S. treasuries. If China and Saudi Arabia are no longer recycling their trade surpluses into U.S. bonds, who is going to fund the U.S. deficit? The Fed. This geopolitical shift accelerates the bond crisis. It creates a feedback loop. Foreigners sell bonds, yields rise, Fed prints money, inflation rises, dollar weakens. Foreigners sell more bonds. It is a death spiral. And silver is the lifeboat. Why silver specifically? Why not just gold? Because silver is the people's money. Gold is too expensive for the average person to buy in significant quantities. When the masses wake up to the inflation crisis, they will turn to silver. It is affordable. It is recognizable. It is portable. The inflow of retail money into silver will be the final stage of the rocket. Also, consider the green energy paradox. Governments are mandating a transition to green energy, which requires massive amounts of silver. At the same time, their monetary policies are destroying the incentive to mine. Inflation makes mining more expensive: fuel, labor, equipment. ESG regulations make it harder to open new mines, so we have government policy stimulating demand while simultaneously strangling supply. This is a recipe for a price explosion. The forecast of $300 to $500 is not pulling numbers out of a hat. If you adjust the 1980 high of $50 for true inflation, using the methodology from 1980, silver hit the equivalent of several $100s back then. We are just returning to those levels of purchasing power. We are correcting the suppression of the last 40 years. But let's talk about you. What should you do? If you are watching this, you probably already own some silver. You might be feeling anxiety. Should I buy more? Is it too late? It is not too late. As long as the bond market is broken, the trend is up. But you must be disciplined. Do not buy with money you need for rent next month. This is a volatile asset. Only invest capital that you can afford to leave untouched for the duration of the cycle. And prepare your mind for the wealth transfer. This is the greatest transfer of wealth in human history. Wealth is moving from those who hold paper to those who hold real assets. It is moving from the creditors to the debtors. It is moving from the oblivious to the prepared. You are on the right side of this trade, but you have to stay the course. The media will try to scare you out. They will call silver a barbarous relic. They will say the rally is a speculative bubble. They will tell you that the government has everything under control. Do not listen to them. Look at the bond market. The bond market never lies. The bond market is screaming fire, and the smoke is billowing out of the windows. When T-bonds panic, everything changes. The correlations break down. Stocks might crash while gold soars, or stocks might soar in nominal terms but crash in real terms, like in Venezuela or Zimbabwe. The only thing that maintains its purchasing power is the hard asset. Gold at $8,000 is just the beginning of the repricing of the global balance sheet. The world has too much debt and not enough collateral. Gold is the ultimate collateral. It is being revalued to balance the books. Central banks know this. That is why they are buying. They are preparing for a system reset. In a reset, the price of gold is set much higher to cover the outstanding currency. If you back the U.S. monetary base with gold, you get a price of $10,000, $20,000, or more. $8,000 is just a pit stop on the way to reality. And silver? Poor, undervalued, manipulated silver. It will snap back like a rubber band that has been stretched too far. The ratio will compress. The industrial shortage will bite. The investment panic will hit. And we will see prices that seem impossible today. Imagine a world where an ounce of silver buys you a week's worth of groceries. Imagine a world where a tube of Silver Eagles pays off your mortgage. This is the potential of the wealth transfer. It is not about getting rich in dollars. It is about becoming free. It is about exiting the debt slavery system. The nuclear panic in the bond market is the trigger. The fuse is lit. The explosion is coming. It will not be a singular event. It will be a process. A series of crises, interventions, and failures, each one driving the price higher. Each one validating your decision to stack. So take a deep breath. Look at your stack. Realize what you hold. You hold insurance against the failure of the state. You hold a claim on the future of energy. You hold the only money that has stood the test of time. Do not be shaken out by the volatility. Do not be fooled by the tough talk from the Fed. Watch the bonds. As long as yields are volatile and the debt is growing, you hold on tight. The ride to $300 silver and $8,000 gold will be the wildest ride of your life. But if you keep your head, if you understand the macro mechanics, you will arrive at the destination with your wealth intact and your future secured. This is not just a trade, it is a paradigm shift. The era of paper is ending. The era of tangible assets is returning. Stay alert, stay educated, and keep stacking. The best is yet to come. The bond market is breaking, and that is the sound of opportunity knocking on your door. Do not be afraid to answer it. This video is an alert because the data has changed. The speed has changed. The compression of time means we don't have years to prepare anymore. We might only have months or weeks before the next leg up leaves everyone behind. The urgency you feel is real. It is your instinct telling you that the ground is shifting. Trust that instinct. The vibration in the cathedral floor is getting stronger. The pillars are shaking. Get to the lifeboats, get to the gold, get to the silver, and wait for the dust to settle. When the dust settles, the paper world will be in ruins, but the metal will still be shining. That is the promise of gold and silver. That is why we stack.